Zoom video communications is one growth stock down 87.3% that I think you're going to regret not buying on the dip right now. Of course, the company was a huge beneficiary of the pandemic, and now that economies are reopening, people are using Zoom less often. However, there's still a good reason to buy Zoom stock right now, and I think you might regret it if you don't buy it at this moment down this much. This video, I'm going to explain why I think that's the case, so I don't think you're going to want to miss that, so let's get right into it. So looking at Zoom's revenue, you can see that huge explosion during the pandemic. You saw Zoom was growing nicely even before the outbreak, but once COVID-19 hit and we were learning and working from home, revenue absolutely exploded from, let's say, around 600 million. It jumped all the way up to $4 billion. And the good news is that Zoom has retained that explosive revenue surge that it gained during the pandemic. Look, it's still, as of its most recent update, it still earned 4.4 billion in revenue. It's not like revenue exploded and then right when economies reopened, revenue crashed again. That didn't happen. Zoom retained most of those, many of that, and even on built on top of that growth. So it's not going away. And I'll give you one use case. If you're not aware already, I am a professor at a university. I teach finance and economic courses for undergraduate and graduate students, and I've been using Zoom for office hours even before the COVID-19 outbreak. So it is a very helpful tool for when students want to meet with me in office hours but don't want to travel all the way to campus because that can be a difficult trip for some students who don't have transportation. Additionally, of course, the very, very useful case was during the outbreak, I was able to deliver lectures over Zoom and then record the lectures, and students can go back and watch the lectures if they weren't able to attend the live lectures. And that's going to continue being useful even after, even now, sometimes there are cases where I will use Zoom to deliver a lecture, and students can then go back and view that lecture if they weren't able to attend during live class. And at the university, we have completely online classes still, where the entirety of the semester is delivered online completely. There is no face-to-face meetings. So Zoom will continue to be incredibly helpful in those use cases, even if it's not what everyone is using to work and learn from home. Of course, it's not going to be as popular and as used as it was during the early stages of the pandemic, but it doesn't have to be a really good investment. It doesn't have to be the case that Zoom video is used as often as it was during the pandemic in order for Zoom video to make a good investment for you. Here is where Zoom has been affected since the economic reopening. So we saw earlier that revenue has remained elevated for Zoom video, but what has come down is its operating profit margin. See, during the peak of the pandemic, its operating profit margin was north of 24%. That has come all the way back down to 5.6%, but still above the level where it was at before the outbreak. You might ask, why is the operating profit margin down? And it's because Zoom is having to work harder to retain those sales. During the outbreak, during the earlier stages of the outbreak, Zoom didn't have to do anything. Customers were flocking to Zoom to sign up and to buy Zoom's services. Now Zoom has to send out its sales team, follow up with its sales team, maybe travel out to clients and work hard, negotiate, and try and secure these contracts, these sales, where earlier in the pandemic, those sales were coming with a snap of a finger. It didn't even have to lift a finger. customers were automatically going to its website and just purchasing without asking any questions. So that's the big difference between Zoom during the outbreak and Zoom now that economies have reopened, is that Zoom needs to work harder to secure sales. But we could see here that Zoom video communications, what I have here is the cash flow from operations over the trailing 12 months. This hasn't come down all that much, right? So before the outbreak, it was delivering roughly 200 million in cash flow from operations. That exploded to near 2 billion, nearly 10 times higher, and has come down a little bit to 1.3 billion, still multiples higher than it was before the outbreak. So it signed up a lot of clients, and those clients are still using Zoom, right? Yes, people are going back to work, but people are not necessarily going back to work 5 days a week. People are maybe going back to work 3 days a week, 4 days a week, and the other day they're communicating with their office over Zoom. They're working from home. So the use case has it is higher than before the outbreak, although not as high as the peak. So, it's still a really good, useful company that's delivering revenue growth, delivering healthy cash flow from operations growth, positive profit on the bottom line, and the operating profit is higher than where it was before the outbreak. I want to thank the Motley Fool for sponsoring this video. Visit fool.com/parkev for the 10 best stocks to buy now. And the final reason why I think you might regret not buying Zoom stock on this massive dip is because of its favorable valuation. People are treating Zoom as if it's completely finished growing, as if it's not a growth stock anymore, as if its growth days are behind it, which I don't think is the case, as we saw with the revenue growth earlier in this video. But look at the valuation. It's trading at a forward price to earnings ratio of 16.49, near the lowest it's been going back about a year and a half, and it's trading like a non-growth stock. It's trading like a similar valuation as you would find some brick and mortar retailer stocks, right? Like Home Depot is trading at a forward price to earnings of around 18. So it's cheaper than a stock like Home Depot, which is not going to grow anywhere. Well, it's going to grow, but at mid single digits, whereas Zoom, I think, can experience double digit growth once the headwinds from customer losses from the peak is worked through, right? Like once it rebalances to this new equilibrium, from there it can continue growing as it expands, reaches new customers, offers customers new use cases. It can continue growing. So it's very much a growth stock, valued as if it's a non-growth stock. So for all the reasons I mentioned earlier in this video, I think Zoom is one growth stock that you might not regret not buying on this dip here. So that's all I've got for this video. Thank you so much for watching. I've got some videos coming up on your screen right now that I think you'll enjoy. So please click one of those and I'll see you over there.